What if I told you that I quietly made over $400,000 doing something so simple you will just go, yeah, that makes sense. I should have done that. Today, I'm not just telling you my story, I'm giving you a complete framework that you can apply yourself. Let me show you my exact process through my Meta case study, a real investment that returned over 400% in less than 2 years while most investors were running away in fear. As Warren Buffett's teacher Benjamin Graham wisely said, the intelligent investor is a realist who sells optimists and buys from pessimists. This simple concept is at the heart of what I'm about to share with you today. So, step one, find your circle of competence. It was late 2022 and Meta's stock price had fallen hard. From a high of $300 per share, it crashed down to just $90. That's a massive 76% drop. Every financial expert was saying that Facebook was done for. Apple's privacy changes were hurting their ad revenue, TikTok was stealing their users, and Zuckerberg was wasting billions on his metaverse dream. But I saw something almost no one else did because I had worked in digital advertising for years, using Facebook's ad system every single day. I knew something that Wall Street had completely missed. Meta's advertising system was so deeply integrated into the marketing ecosystem that companies couldn't just simply stop using it overnight. This insight came from my own experience spending millions on Meta's ad platform yearly. Unlike Wall Street analysts who only reviewed quarterly reports, I was seeing the real effects every day in my work. I understood the platform's value proposition in a way that most investors couldn't. So the key point here is to identify industries where you have a deeper knowledge than the average person. This could come from your job, your education, or areas where you've done extensive research. Your unique knowledge creates an information edge that most investors simply don't have. All right, step two, look for extreme market overreactions because the fear around Meta was overwhelming. Jim Cramer on CNBC, who used to love Meta, suddenly changed his mind and told people to sell immediately. Wall Street analysts were predicting the stock would continue its downward spiral. The market had essentially given up on Meta, with many institutional investors dumping their shares in a panic. And I don't get too excited about normal market volatility. I wait for extreme overreactions, not just 10% or 20% drops, but 50% or more crashes driven by short-term fears rather than fundamental business problems. Meta had fallen 76%, a classic panic-driven collapse that had more to do with emotion rather than rational analysis. Now, this next framework point is crucial. Create a watch list of great companies in your circle of competence and be ready with cash when the market panic creates rare buying opportunities. These moments of maximum pessimism often represent the best entry points for long-term investors. Step three, analyze the business fundamentals, not the noise. While everyone focused on negative headlines, they completely missed several critical facts about Meta's actual business performance. Their user numbers were still growing. Daily active users across all their apps had actually increased 4% year over year. The company was aggressively buying back its own shares, $24.5 billion worth in 2022 alone. Meta still had over 3.7 billion monthly users across its family of apps, and profit margins remained above 20% even during this crisis. And perhaps most importantly, the company had over $40 billion in cash with almost no debt. This wasn't a company in terminal decline. This was a company confident enough about its future to spend billions repurchasing its own shares when prices were depressed. Management was literally putting their money where their mouth was. So the key insight here is that when analyzing a potential investment, you need to separate market noise from business reality. Focus on user growth, profit margins, cash reserves, and management actions rather than headlines and short-term sentiment. The most valuable information is often found in the financial statements, not the media narratives. Step four, apply the 95% rule for conviction. When Meta hit $97 in November 2022, I did something that seemed completely insane to everyone around me. I went all in. Not just a small position, I moved a substantial portion of my available investment capital into this one stock that everyone else was frantically selling. I used what I called my 95% rule though. If I wouldn't feel comfortable putting 95% of my net worth into it, I don't even buy one share. This extreme selectivity means I make very few investment moves, but when I do, they're based on exceptional conviction. The framework point here is very simple, but it's powerful. Only invest when you have extremely high conviction, whether you're buying one share or 10,000 shares. If you wouldn't feel comfortable putting 95% of your net worth into that stock, do not even buy a single share. This mental model forces you to do thorough research and only act when the evidence is overwhelming. This will also stop you from buying silly penny stocks and reduce poor or impulsive investing decisions. Step 5, create an investment tracker to fight emotional decisions. Because for weeks after buying, I questioned everything. The stock didn't immediately recover. Some days it dropped even further. Financial media continued to predict Meta's demise. And to combat these doubts, I created what I call an investment tracker, documenting my original investment thesis and updating it as new information emerged. This helped me distinguish between normal market noise and the actual material changes to the business. When Meta announced its year of efficiency in early 2023, focusing on cost cutting while maintaining investment in core growth areas, I added this to my tracker as confirmation that management was addressing real problems without abandoning its future growth opportunities. This reinforced my conviction when the stock was still depressed. The key lesson is to document your investment thesis before buying. Write down exactly why you're investing and what would need to change in order for you to sell. This creates an objective reference point that helps you avoid making emotional decisions during periods of volatility. All right, step 6, practice strategic patience. The waiting was undoubtedly the hardest part. As weeks turned into months with minimum price movement, doubt really started to creep in. Had I made this horrible mistake? Was I seeing only what I wanted to see? This psychological battle is where most investors fail, not in their analysis, but in the ability to stay the course. But I committed to holding for at least 5 years unless the fundamental business deteriorated dramatically. This removed the daily anxiety about price movements and the temptation to take quick profits. And when Meta doubled from my purchase price within a year, many advised me to just take those profits, but I refused because my analysis still indicated the business was still undervalued. The framework insight here is to set a minimum holding period based on your analysis, not market movements. As Charlie Munger said, the big money is not in the buying and the selling, but in the waiting. Patience is truly the investor's most valuable asset. Step 7, use the barbell strategy for portfolio management. Fast forward to today, Meta is trading around $500 per share. That's an astonishing 415% return in less than 2 years. My investment grew to more than 5 times its original value, but don't misunderstand me. This isn't my entire investment approach. The majority of my portfolio remains in low-cost index funds, and I maintain a small portion for shorter-term opportunities. However, these rare, high-conviction individual stock investments are what have generated outsized returns over time. So think of it like a barbell. Keep most of your investments in broad, low-cost index funds for safety and diversification, with a smaller portion in high-conviction individual stocks where you have a genuine informational edge. The key point is to balance safety and opportunity by maintaining the bulk of your investments in the diversified funds while allocating a portion to the high conviction picks where you possess a unique insight. This provides both security and potential for exceptional returns. To visualize exactly how this barbell strategy could work with your specific investment amounts, check out the free investment profit calculator in the description and the first pinned comment below. Now, let's examine the results and lessons learned. What's fascinating is how predictable human behavior becomes during market panics. Throughout history, we've witnessed this same pattern repeat with different companies. Look at Amazon during the dot-com crash, Apple after Steve Jobs passed away, or Microsoft when conventional wisdom declared the PC is dead. Everything that is literally happening right now in April 2025. Each time, overreactions created extraordinary buying opportunities for investors who understood the underlying business. While the S&P 500 returned approximately 24% in 2023, my Meta position gained over 200% during that same period. This single investment outperformed the broader market by a factor of 8. And this validates Charlie Munger's wisdom about the importance of patience. What's really instructive is that Meta's recovery wasn't driven by some revolutionary new technology. The comeback resulted from the company refocusing on its core strengths: advertising efficiency, user engagement, and operational discipline. The market had priced Meta as if it was facing extinction, when it was simply experiencing a temporary adjustment. Research consistently shows the average individual investor significantly underperforms the market primarily due to emotional decision making rather than poor stock selection. Fear, greed, recency bias, and herd mentality create a persistent gap between market returns and investor returns that typically exceed 4% annually. That is an enormous difference when compounded over decades. So, how can you apply this framework to yourself? What actionable insights can you take from my experience? First, identify industries where you have a deeper knowledge than the average person. Second, create a watch list of great companies in those industries and follow them closely. Third, be prepared with available capital when the market panics and creates rare buying opportunities. Fourth, only invest when you have extremely high conviction. Fifth, document your investment thesis to combat emotional decisions. Sixth, practice strategic patience with minimum holding period. And seventh, balance your portfolio with the barbell strategy. Remember, investing doesn't need to be exciting to be profitable. Sometimes boring is beautiful. And that simple philosophy made me $400,000, and it might just transform your financial future as well. My meta experience illustrates a timeless truth. The stock market systematically transfers the wealth from the impatient to the patient. By combining specialized knowledge with emotional discipline and strategic patience, you can position yourself on the receiving end of that wealth transfer. The question isn't whether similar opportunities will emerge again. They always do. The question is whether you'll be prepared to recognize them and courageous enough to act when they do appear. All right, watch these two videos for more investing tips. Bye, guys.